That is the ease of use for advisors leveraging alternatives. The 60/40 has shown some kinks in the armor. And what has helped be the buoy of these very traditional portfolios is to have made some room and maybe dial back to a 40-30-30, where now the new 30 is alternatives.
You're listening to The Uncertainty Edge, the show about the art and science of moving forward when the path isn't clear. I'm your host, Sam Sivarajan. Each episode, I sit down with leaders, advisors, and thinkers to explore how they navigate uncertainty, make better decisions, and stay focused in a world that rarely cooperates. Together, we'll look for the clarity hidden inside uncertainty. Hi, everyone, and welcome to The Uncertainty Edge. I'm your host, Sam Sivarajan. Today, I'm joined by Alan Strauss, a managing partner at Crystal Capital Partners. He spent 3 decades navigating the complex world of institutional-grade alternative investments. Alan has led his firm through multiple market cycles, from the dot-com crash to the financial crisis and beyond, building a platform that democratizes access to elite managers for qualified investors and their advisors. With over $1.3 billion in assets under management and almost 10% of that being the firm's own capital, Alan brings a rare combination of institutional rigor and genuine skin in the game alignment. Today, we're exploring how financial advisors can cut through the noise and alternatives, make confident decisions in the midst of market uncertainty, and transform what many see as complexity into strategic opportunity for their clients. Alan, welcome to the show.
Thank you so much for having me, Sam. Really appreciate it. I've watched many of the episodes previously, and I'm almost so humbled by your very, very thoughtful introduction.
Well, it's very kind of you to say so. I think this conversation is timely given where we are in the market at this stage. So, Alan, as I said in the outset, you've navigated 3 decades in this alternative space through the dot-com bubble, the financial crisis, and today's challenging environment. What pivotal moments or high-stakes decisions have shaped your approaching to building Crystal Capital Partners? And what did those experiences teach you about leading through uncertainty?
Well, first, let's be candid. I haven't done it alone. It takes a team effort, and I'm a big believer, even though I was a college swimmer, but I'm a big believer in team concepts. Effort outlasts everything else. It's helpful to have some talent. But being able to have gone through, as you alluded to, multiple market cycles, which in the grand scheme of things have not been that far apart from one another. And so these black swan events or these really intense dispersion events happen frequently. So when you go back to .com was very opportunistic. GFC created a situation where there was a real identification of the structural inefficiency that was the fund of hedge fund world. It continues to be in favor today, but our view, which is why we've taken the evolution from then, and that was really the genesis moment. Instead of having pooled vehicles, the difficult decision, and it kind of came from discussions with prospective investors as well, where folks were saying, how do we begin to customize our exposures to this world? How do we begin to select things that really matter to our objectives, as opposed to buying a product that's supposed to be one size fits all? And it really coincided with the world of everything else becoming so much more customizable. Nobody walks onto a car lot and only picks the car that's available that day. Walks into their fast food let's not use that word today. Nobody walks into their favorite restaurant, which is fast casual, and only takes the item that's available on the menu. There is a lot of customization around it, or even your music playlist. So that was a tremendous opportunity for us to really evolve the business forward. And then obviously we've seen the decision-making process continue to reward us for making that choice and build something more scalable, more dynamic, as opposed to something that is centrally product-centric. And the global pandemic and where we are today, continuing to see volatility is the essence of that. Not a singular product, but to be able to enter this asset class for investors who already are, or investors who are looking to it, to do it in a dynamic approach.
You said something interesting at the outset about these black swan events occurring relatively closely together. I think, as you were saying, I had to smile because it reminded me of, you've come across it, I'm sure. It was a comment made by the then CFO of Goldman Sachs around 2008 that they had been observing 25 Sigma events several times in a week. And this, as a student of markets, et cetera, Sigma event is supposed to occur 1 in 100,000 years. So to have 3 or 4 of them happen in the course of a few weeks is either extremely unlucky or our models don't necessarily work as well as we think. Which is, I think, where the genesis, as you say, of alternatives comes from. It's position one's portfolio to cushion, if you will, the blows that these kind of, 5 Sigma, 3 Sigma, 25 Sigma events are supposed to impact on your portfolio. But there's a persistent question that I think advisors grapple with, and I'm sure you hear it. Isn't it too late in the cycle for alternatives? I mean,
That's
we've seen in the last few years high profile cautionary tales from the likes of CalPERS, the big California pension fund, their experience with hedge funds. When markets feel frothy and uncertainty is high, how do you and your firm help advisors think clearly about the timing, the opportunity, and the risk that is with this asset class?
Well, I think therein lies the most important or $64,000 question or topic of conversation. Alternatives are not designed, in our view, to be opportunistic. Investors can take opportunistic strategies into the context of proper asset allocation, meaning today I want exposure to low vol hedge funds. And in time, I would look at my private markets portfolio and I'm someone who is in the need for income, but dynamically 6 months, a year, 2, 3, 6 years from now, as there are different things evolving, I may have a need for growth equity or buyout. And from that standpoint, I may want early stage VC as opposed to middle market growth equity. But specific to the topic that you're bringing, Sam, alternatives should be evergreen, right? At this point in time, we have sufficient data, over 40 years now of data of watching alternative investment strategies, which should be measured based on the skill of the manager. They are very different than traditional investments, which are ultimately measured based on the market's direction. So now getting exposure to these strategies is about creating a plan or a process for investors. When you look at institutional allocators who have foundations, endowments, you alluded to CalPERS, and that's a very different dynamic to discuss, potentially for another podcast or another question, as to the dynamic of an institutional allocator versus a high net worth client. So as an investor, the goal of alternatives should be really threefold. There is an element that provides capital preservation, the shock absorbers to the portfolio, the risk mitigation component. And in our view, those are hedge fund strategies. And there are many different types of sub-strategies that can fill that mandate. Then there are elements of income. And when there is a need for income at a premium to what traditional fixed income historically provides, that's where investors start to look at private credit. And the third layer is the growth potential. Can public equities, as we see them today, continue to grow at exponential rates? Anything is possible, Sam, right? Mm-hmm. But if you look back 20 years ago at the S&P 500, it looks very different today than it did back then, which is only a call to private markets. We have continued to see public equities shrink through time, almost 50% less available investable opportunities in public markets in the last 2 decades, whereas private markets continues to offer opportunities. If you're talking about simply being timing oriented, then you're very transactional. And that's really not the way that we would approach investing and utilizing alternatives for that matter. This is about implementing a process through time that when you're looking at a hedge fund portfolio that can deliver risk mitigation and low correlation, should be able to compound at a very attractive rate of return through time. Think the tortoise and the hare, and the tortoise always wins.
No, I think that's an important distinction that you make there, Alan. I think you're absolutely right that you wouldn't think of a bond component to your portfolio or an equity component to your portfolio as to whether the timing is right. You would have it as a long-term component of your portfolio with tactical shifts as may be appropriate.
That is the operative word. That's a great word. The tactical shifts, having a plan in place and appropriately deploying assets across alternatives for their intended goal allows you to also be tactical from time to time.
I want to explore the point that you did raise in that last comment that you made, which is a little bit about maybe CalPERS experience without specifically talking about them. But why is it that some prominent investors have soured, if you will, on an element of alternatives? You also talked about distinguishing between the institutional allocators and call it the high net worth investor, which is the target, the audience, the advisors that are listening to this podcast, that's their client primarily. So maybe you can speak a little bit about both of those elements.
Okay, so let's take a quick step back. When you look at the world of alternative investments, not all managers are created equal. We touched on it in the open. Alternatives have become such a talked about asset class that today they're pretty mainstream. It's a multi-trillion-dollar industry. And there is a tremendous bifurcation within the industry of those that we view at Crystal as asset managers, where there's alignment of interest. The GP, just like here at Crystal, substantial part of the assets are their assets, and they're really sitting on the same side of the table with their investors. And then you have those that are asset gatherers, that there's nothing wrong with these managers, but they are houses that are generating products and the continued proliferation to gather assets. And there's nothing wrong necessarily with these products, but there are certainly managers that deliver a slightly higher deliverable, let's call it that, and stay in compliance-friendly places, but that are providing through time a much more attractive value proposition for their investors. Those have high barrier to entry. Those have high expense ratios, right? Because there is a lot of meat on the bone for their strategy. And as a result, they have the ability to not be open to just every single investor. So that creates barriers to entry, either by minimum, by being an LP who'd like to invest in some of these GPs. And when you're a large institutional allocator, you also tend to have the ability to throw your weight around. And as a result, and going back to what I said a few minutes ago, not all managers being created equal, the large established asset managers, because their capacity is finite, we understand market dynamics, supply and demand. They're not necessarily having to be in a position where they have to cater to the specific demands of any particular investor, but can really provide a very egalitarian approach to receiving and accepting investors. And they keep fee structures identical for all clients. When you're a very large institutional asset gatherer, and specific to the one that you alluded to, look back at what their roster of managers at the time when they made the decision to exit alternative investment strategies and what it was. You are not going to find a large number of top decile funds in their portfolio. And I think that was the unfortunate part. Again, not all managers being created equal. It becomes very important for the advisor and the investor to find those managers. There are over 10,000 hedge funds and another 10,000 or more private funds. So it's important to be able to whittle down that universe, think of the funnel approach, but to find that really top 1 or 2% of funds that through time do provide substantial value, and the value proposition is well received by their investors. In other words, are they generating attractive risk-adjusted returns through time?
It's a great point. I think coming back to the timing point of view, I think that the attention that alternatives may have gathered in the last little while might be tempting for advisors or clients who are relatively new to the space to say, well, I got to get on this ride. And that is where the problem might lie, because there isn't necessarily a strategy, and you're coming in in a frothy market, trying to get access to a lot of the top names that might be closed. And as a result, the temptation might be that I want exposure to this asset class, so I'm going to pile in at the top of the market, maybe perhaps not the top names, which creates part of the problem. Would that be fair?
Sure. And I think you're alluding to it. You mentioned I want to get in to get exposure to the asset class. And some folks come in with that mindset, but then inevitably you have conversations of them saying, all right, well, if I need private credit, I found one private credit manager, I've touched all the bases. We then throw out the elements of diversification. We can't have one manager that does a specific discipline. We may want 2 or 3 or 4 so that we can create a well-rounded approach. But again, that has so many significant barriers to entry. So for advisors, it's really today about finding solutions that are scalable, solutions that help generate revenue for their businesses, solutions that provide a true partnership so that a lot of the heavy lifting due diligence, execution, reporting are really removed from their hands so that advisors can do what they do best, which is to provide behavioral and investment management to their clients.
So I want to dig a little deeper into the point that you made, that really that there's, if you look at alternatives, you should really think about three very different objectives. So capital preservation, income generation, and growth. So when an advisor is sitting across from a client who's anxious about market volatility or uncertain about their financial future, how do you recommend that advisors think about these three different levers? How do they diagnose which of these matters the most for their client and construct an evergreen allocation, if you will, a diversified alternatives portfolio accordingly?
That's a great thought. So, an advisor today, we established that alternatives are pretty mainstream. If you look at investing as really a three-legged stool, and we'll use this theme of three, the three-legged stool looks at public equity, public fixed income, and then the third tier being alternatives. Mm-hmm. Now, alternatives have become also a very large category. You could throw from crypto to collectibles to wine to hedge funds, private equity, and private credit into the same bucket, so to speak. So let's focus on just three primary ones, which are the three levers that we like to talk to advisors about having the ability dynamically to exercise. Many investors, depending on their time in life, as well as their current career and their income generating capabilities, that if they're in a very high earning part of their life, most likely income is less of a consideration, right? And they can stomach volatility. They're probably looking at higher growth strategies, but for other passive investments, they may couple that with hedge fund strategies because of the need for having an asset class that can compound an attractive rate of return. And that really is at the crux of it. It's for the advisor to understand, and they know this. I mean, advisors are clearly highly intelligent people who have a very large responsibility to their clients as custodians of their assets and their family legacies, and having those deep conversations to get an investor to have the opportunity to plan forward and look ahead and understand what is the process they're trying to implement. So then you start to identify very quickly, all right, what is the appropriate lever? We have equity. We have someone who's built up, tremendous success of their personal income because of the businesses they've owned, and now has savings. And what we're looking to do is take chips off the table. That individual is clearly a hedge fund investor, wants to compound an attractive rate of return, reduce equity-like volatility. I mentioned it before. The real value of hedge fund managers is not their ability to navigate the market, not to be the direction of the market, but really their skill and navigate market direction appropriately, whether they need to be long or short or a combination of both, depending on what economic cycles dictate. Mm-hmm. And that becomes a very important dynamic because that is an evergreen solution in terms of the ability to deploy capital, invest in a handful of managers, and be able to make changes through time. Because hedge funds are not illiquid, despite the misconception that exists out there. So portfolios have liquidity. Selfishly, I can tell you that platforms like Crystal allow advisors to do this and do it seamlessly and be able to move from fund A to fund B, from multi-strat to distressed credit based on the liquidity of those underlying exposures, and do it the way large institutions historically have. Importantly, also, in terms of that asset allocation, a hedge fund portfolio can definitely have a core and a satellite approach, with the core being defensive risk mitigating strategies and having a handful of satellite allocations that, using your word, can be more tactically deployed, whether the opportunity set could be in distressed credit or whether it could be around long short equity that may have a specific flavor behind it, whether it's a focus on technology or a focus on US and European equities, as an example, right? So that's really the basis of when you start to determine, is this investor looking at compounding? And that's typically, individuals you find that are starting to get to later years in their career, because they certainly can't wake up tomorrow morning and see their IRA or their retirement having dropped 40% with the market, if that's what it did, right? We talked about those multi-sigma moves.
And look, and I think it's again, the parallels to traditional investing is pretty stark here, right? I mean, you're not going to have a retiree have all of their portfolio concentrated in one stock or even in a handful of stocks when they're on the cusp of retirement. I think to your point, it's the same thing. Like any of these portfolios need to continually be calibrated to the age and stage of your client's life cycle, but also what's happening in their personal life in terms of their need for liquidity, their need for income, their need for preservation, and all of it. And you're just adding on the other additional lens, I guess, of the fact that there's less liquidity perhaps in the alternatives, although you've talked about a platform like yours allowing still some degree of liquidity. But the iconic feature, if you will, of alternatives in my mind is that there is less liquidity than the traditional markets, but that less liquidity is also why you get a higher premium of returns.
No question, the illiquidity premium. And that's
Right.
what all investors should be striving for. But it's important to monitor and judge alternative investment managers that if the illiquidity premium is not being delivered, in other words, in simple form, as you said it, if I can't get my cash within a daily period like I could in daily equities or in traditional equities, but I'm not generating a return at a premium to that, then that trade is not idiosyncratic enough.
Right.
And it's, I would add just one more thing, right? The time tested asset allocation model is the 60/40. And no one is suggesting to throw that out, but that is the ease of use for advisors leveraging alternatives. The 60/40 has shown some kinks in the armor, especially if you go back only 3 years. And what has helped be the buoy of these very traditional portfolios is to have made some room and maybe dial back to a 40-30-30, where now the new 30 is alternatives. But again, to be able to accomplish that, we suggest advisors find partners, platforms that are helping them with a lot of the elements like due diligence and execution and reporting and analysis, and really just having a team to make those decisions as effectively as possible.
Now, Alan, we talked about the fact that your firm operates with significant amounts of your own capital invested alongside advisors and clients' capital. So genuine skin in the game. That's a powerful alignment signal to the market, but it also suggests deep conviction in your approach. Walk us through a moment when that personal stake influenced a critical decision, especially during periods of high market stress or uncertainty.
I can highlight two for you. Never before was it more present than in 2008, when folks felt like the world was coming to an end and we may be headed for a barter system. And obviously our fund to fund structurally inefficient. We discussed that when you're pooling client liquidity and clients' behavior is dictating how they're managing their finances, obviously everyone behaves very differently, right? And that fickle behavior leads to whatever the decision making ultimately is, and sometimes detrimental. Being large investors in our own structures then, as we continue to be today, it allowed us to say, follow the smart people and follow the smart money. Institutions back in the 90s, allocators, I was going to say, so institutions back in the 90s, just as today, are really the largest allocators to well-known funds with a lot of longevity in the hedge fund space, these institutional managers, as we term them.
Right.
And it was our desire, having multiple meetings with managers, that it was market inefficiencies and a number of other factors that led to the GFC, as opposed to the hedge fund industry needing to be discarded. So that decision clearly was rewarded, and we continued to make a concerted bet on hedge funds and hedge fund managers, and them being able to be a distinguished asset class that continued through time. The next important element was, again, watching hedge fund strategies in what is arguably sort of the lost decade of hedge funds from around 2011 or 2012 up until the pandemic. And in that time, we had already been exploring the idea of private markets and then launching private equity, so that we would essentially have the ballast on both sides, so that investors and advisors, and that was clearly happening. We had many advisors at the time in the early 20s who were saying, it'd be great if I could also build portfolios of private markets and take advantage of that and be able to do it in one place where I already have knowledge of your systems and we're already used to the reporting and it's already seamless for our clients and they're familiar. So that was it was a bold move for us to be able to introduce private markets and to be able to do from a technological standpoint, right? The interface had to be upgraded and continue to evolve, to also beginning to facilitate the relationships in the same vein with the same level of pedigree, same discipline that these managers have, same skin in the game. So our PE and our hedge fund parts of the platform are completely identical. It's just that you're able to build a portfolio of hedge funds versus a portfolio of private markets. And I think those two decisions have led us to where we are today. We certainly had a little sweat under the brow, but we continue to move forward and evolve. And today we've got 1.3 billion in assets and over 300 RIA clients nationwide. And the business is a 20-year startup, but it's in its most historic place yet.
Awesome. Now, on that lines, along your move into private markets, private credit has surged in popularity over the last 5 years, shall we say. But you've noted that it's been gaining institutional traction for well over 2 decades. For advisors who are evaluating this space now, in the midst of rising rates, credit concerns, economic uncertainty, what should they understand about separating genuine risk-adjusted opportunity from simply chasing yield for the sake of yield?
You got to look at the report card, right? So in other words, the performance metrics of a fund manager. And we think that having a track record that gives us the ability to understand how a fund has performed in multiple rates cycles is a very clear indicator of what their success will continue to be. You take managers that have been around. So now, two elements, right? Institutional allocators, again, who have had no barriers to entry or very low barriers to entry and are deploying, in some cases, hundreds of millions of dollars into the asset world of alternatives, can pick and choose what they want. Now, you look at what high net worth clients get relegated to, and they start to buy product. We've all heard the saying, if it's too good to be true, it probably is. So if rates are where they're at, how much more juice without financial engineering that could be dangerous if all the house of cards fall? What types of managers are you really looking at? So it's critical to look at managers. It's critical to look at managers that not only have had decades long of experience, but continue to provide, regardless of what or where the rates environment is, that continue to provide a premium to traditional fixed. So it's coupled both, right? What's the strategy? Who are they lending to? Have they had a long history of avoiding defaults? And are they continuing in a rate cycle that fluctuates? Because they do. Are they continuing to provide that premium? And then the last element has to be diversification. Don't fall in love with just one manager. There are many different strategies in the credit world that can all lead toward creating multi-credit exposure that generates attractive yield for the investor based on where they are in their life cycle.
No, I think that's great insight. As you were talking, it just strikes me that, look, we've seen lots of managers, like having that track record through multiple market cycles, the rate cycles, I think is critical. It shows that they're able to weather storms accordingly, that they have the right kind of risk management and compliance structures in place. So that's a little bit of the past element. That where they're investing now and how they're positioning their portfolios now is equally critical, because we've seen managers that have survived 2 or 3 previous cycles and yet have fallen to the last one because they weren't able to adapt their game well enough. So I think that element is important. But I like your third point, and I think it's very important, is the idea of diversification. So diversification across asset classes, diversification across investment styles, diversification across managers, I think is absolutely critical, especially as you're entering an environment where there's so much unknown and so much uncertainty ahead of us.
Without question, especially the uniqueness of certain strategies. Technology, for example, most people only look at technology and software in particular. Look how we're doing this podcast, right? We're in different cities and different places, and we're able to connect nonetheless. Software is not just an opportunity for middle market growth equity or large cap buyout on the PE side. It is a tremendous strategy for lending opportunities. Most importantly, because if you think about software, it is the mission critical element of just about every company that is trying to target consumers, right? Whether you have a trucking company, you need to know where the trucks are on the road. Whether you have a widget company that is sending widgets around the world, you need to be able to track those, monitor sales, monitor your salespeople, monitor client engagement, the website. So these are recurring revenue businesses that are very attractive to lenders. And when there is the right lender that understands these businesses, it generates very attractive yield to its investors. So that's one simple example of the need for diversification.
That's great. Now, we talked about the importance of investing with good quality names, and you've shared with me before that some of the top end firms that Crystal partners with, these firms have decades long track records, they're household names, they have minimal default rates even through crises periods. What does anti-fragility, to use Taleb's word, look like in alternative investment management? And how can advisors identify managers who don't just survive volatile times, but actually strengthen during them?
It's going to sound trite what I'm about to say, but the first part is you got to identify a repeatable process, right? The old adage, rinse and repeat.
Mm-hmm.
It is an arms race today in the world of institutional alternative investment managers. In other words, the need to hire and retain top talent is more critical than ever. So it's important for advisors, platforms like ourselves, to look at a lot of the qualitative metrics as well, right? First, are the GPs invested there? Are they continuing to innovate their firm? Are they bringing on the most talented folks? Are they implementing the most cutting edge and talented technology elements, from artificial intelligence to quantum computing? And these are things that are happening in real time, and that asset managers, the ones that have distinguished themselves, will have the ability to implement into their existing infrastructure. Other funds, these are elements that are very cost prohibitive, and if they can't keep up, at some point they will become extinct. And so it's critical for advisors to be able to find these elements and see the writing on the wall. Anti-fragility, right? Nobody is impervious. And it goes back to the element of having a need for diversification, because you can mitigate if and when a manager may stub their toe. That is a very distinct possibility, right? There is a dynamic in this world that baseball players can make it to the Hall of Fame for getting up to bat and hitting it 3 out of 10 times. Yet an investment manager has held their feet to the fire, and if they don't generate triple-digit returns, they're going to get fired. So it's an equation that doesn't make a whole lot of sense, but diversify properly, and then through time, you're able to identify managers based on their track record, and simply to understand that the process they implemented 20 years ago is the same process they carried through 10 years ago and 5 years ago, and that assuming that market dynamics change and their process keeps up with it, that they too will continue to be able, again, to deliver an attractive value proposition to their investors.
Now let's talk about market dynamics changing and the universe changing a little bit, because I think, to your point, we talk about these firms that have long track records, but especially in the nature of, call it hedge funds or private credit or private markets, these funds, there is a point where they can become too big. I mean, it's true in the traditional market space as well. But we've seen very, very strong, big names close their funds. Michael Burry just closed it recently, for example. Julian Robertson had closed Tiger after decades of performance. From the perspective of someone like Crystal, a platform, but I think this helps advisors and clients think about this as well. How are you managing that dynamic? On the one hand, you want to invest in funds or have them on your platform that have this long track record. On the other hand, what worked yesterday may not work tomorrow. And number three, I mean, they may be also closed, right? That's another element of it not working. How are you balancing that dynamic of bringing in new managers, new mindsets, new approaches, new disciplines that might be relevant in going forward, while still keeping true to your process, if you will, or your magic sauce of identifying managers that have a great track record over multiple market cycles?
Those are great questions. We have an internal investment committee that meets on a quarterly basis. We have an internal research team. We also contract out a third-party operational due diligence firm to provide additional complementary work, right, in terms of infrastructure, trading policies, trading capacities of the fund managers we work with. But there's a very important criteria, first and foremost, the institutionality. So the infrastructure, this is qualitatively, right? Again, are the GPs, do they have substantial skin in the game? Are there sufficient systems in place, teams in place, boots on the ground? What is the risk management protocol and processes? And then obviously you get to the quantitative side. So it's important, to use a basketball analogy, there is always going to be a rookie of the year. But if you're headed to the NBA finals and you've got one game to win, and maybe it's the final timeout and the final time the team's going to take the court, while that rookie of the year may be able to get to the basket, you may go with the savvy, long-time all-star veteran who could make that one basket or at least get to the free throw line and score that free throw. And that's really the analogy that I use for the funds that we respect the upstarts. We know the time and the drive and the effort that it takes to develop these asset management businesses, but we're less inclined to take that business risk. So the only way to really mitigate investment risk is to diversify. And the only way to really mitigate business risk is to find managers that have a proven process. So are there managers that within their shops, they see teams leaving? And it's always helpful. These become industry colleagues. And it's important to continuously talk to the funds that we work with and that we've had tenured relationships with to work with us to identify, certainly as there are groups that have left and that they respect. And an important dynamic in the industry is you're seeing more and more of this happening, or you're seeing the creation of more and more pod shops where the GP wants to incentivize its trading teams, its PM teams to stay on board, and will basically create small silos within the overall GP where they can continue trading. And these PMs can feel like they have their name on the door or they have hung out their own shingle. But again, it's critical to find managers that have seen multiple market cycles, because while you look at the pandemic and there may not have been sufficient history for certain trading models to identify how things would evolve, because there just hadn't been another global pandemic within the last 5, 10, but certainly within the last 100 years. And I think you and I can both agree that whatever Spanish flu in the 1900s was not so similar, economically speaking, to what took place in 2020. But we talked about at the outset, these dispersion black swan events happen very frequently if you really look at the data. And then it's important to try to identify managers that can have an idea of how to navigate these times and that have systems in place, or can certainly do a very, very good job of replicating it so that they can create positive outcomes.
I love that rookie of the year analogy. I'm going to use that liberally, particularly
Feel
because
free.
it's been many, many, many years since anyone can consider me rookie of the year. So I think that's it speaks to the age and stage of my life at this stage.
Listen, you and I are in the prime of our career, right? We're not the over the hill veteran just collecting a check on the end of the bench, right? That's where we are.
Alan, looking ahead, as markets evolve and uncertainty remains a constant theme, how do you see the role of alternatives changing in wealth management? And what advice would you give advisors who want to position themselves and their clients to adapt to this changing world with confidence?
Listen, for nearly 3 decades, my portfolio is a 60-40 of hedge and PE, because we eat it, we sleep it, we breathe it, right? We recognize that out of hedge funds, we can generate sufficient liquidity by setting up private market portfolios in an evergreen fashion, like we talked about, which is the consistency of commitments and the deployment of capital. We can also have cash flowing vehicles that give us the opportunity to really stay in the game as investors. The proliferation of product will only continue to intensify. The need for giving clients exposure to alternatives is more paramount than ever. It is more important today for advisors to have a really discerning eye and to genuinely find, if they don't have the expertise internally or the client types that can help them design basically their own offering or their own structure, to really genuinely find platform partners. We're seeing the ongoing growth and recognition of the asset class, which is a great thing because it continues to legitimize it. As I said, alternatives are not that alternative, and they probably should be called mainstream at this point. You're talking about a multi-trillion-dollar industry, but it becomes more necessary than ever for advisors to move away from a transactional approach to alternatives and really look at alternatives in the same vein of a portfolio as they do with clients' traditional investments. And by the way, the investment properties of alternatives and their ability, generally speaking, to smooth out the investment returns of a client have the same benefit from a revenue generating standpoint for advisors. In other words, They don't have daily liquidity. These are priced monthly and quarterly for the most part. So that revenue smoothing allows an advisor to really manage their business more efficiently, as opposed to what could happen with the daily swings of the market, because they have clients in only public investments, which, by the way, have zero barrier to entry. Anybody can be a day trader today. So for advisors, it's really critical that they get a handle on alternatives or find partnerships with alternative investment sources that can help them bring this into their business, because the livelihood of their businesses really depend on it. Clients are talking about alternatives. The talking heads in the media world are talking about alternatives, and the industry has focused there. You see it with not only recognized asset managers, but these very large asset gatherers that are creating that product. So it is a topic of conversation. And if an advisor cannot satisfy the objectives of their client and do it in a high touch and intelligent fashion, the client is going to go elsewhere to do it.
On that note, Alan, we're wrapping up this episode. So I have a few final rapid fire questions for you that I ask all my guests. Number one, professionally, what is the most important lesson you've learned over the years?
Effort is critical. Talent helps, but effort and talent is unbeatable.
Very good. Number two, what is one practical tip you would offer listeners keen on applying your insights?
Slow and steady wins the race. And again, the most time-tested, adage we have, and we all learned it in grade school: do not put all your eggs in one basket. Investing is a through-time endeavor. These are passive investments. You have to have the proper expectation of what that means in mind. Triple-digit returns happen because you and I go to work every day, and the work that we do in the investment are ourselves. But having passive assets for a manager, we have to couple those with the right expectation, and we need to recognize that it is a through-time endeavor.
I love it. Couldn't agree more. Alan, fascinating discussion. If listeners want to learn more about Crystal Capital Partners or connect with you, where do they go?
crystalfunds.com, Funds, or we have also two URLs, crystalcapitalpartners.com, or really just get on your favorite search engine and type in Crystal Capital Partners. Unfortunately, you may find my ugly picture, but you'll get to our website, and we'd love to chat with you.
Awesome. Alan, thank you for joining us today on the Uncertainty Edge podcast.
Sam, thanks so much for having me. I really appreciate it, and I really do respect your work.
Appreciate it.
Have a wonderful day.
In this episode of the Uncertainty Edge podcast, I spoke with Alan Strauss, managing partner at Crystal Capital Partners, about how financial advisors can move beyond the noise in alternative investments and build portfolios that are truly built for uncertainty. Here are my three key takeaways. Number one, alternatives are no longer alternative. They're essential. The conversation around alternatives has shifted from should I to how do I do this well? With public markets shrinking by nearly half over the last 2 decades and clients increasingly asking about alternatives, advisors who can't engage meaningfully with this asset class risk losing clients to those who can. Alan's message was clear. Treat alternatives the way you treat equities or fixed income, as a long-term, evergreen component of a well-constructed portfolio, and not just a timing play. Number two, the three levers. Know what you're solving for. Not all alternatives serve the same purpose. Alan broke it down beautifully. Hedge funds for capital preservation and risk mitigation. Private credit for income generation at a premium to traditional fixed income, and private equity for long-term growth. The advisor's job is to diagnose which lever matters most, given each client's life cycle and risk tolerance, and then build a diversified multi-manager exposure accordingly. One manager, one strategy, one bucket is rarely enough. Number three, skin in the game is the signal. Find it and require it. Alan's firm invests nearly 10% of its own capital alongside clients. That alignment isn't just a marketing point, it's a filter for identifying managers worth trusting. The best alternative investment managers are asset managers, not asset gatherers. They have institutional infrastructure, proven processes across multiple market cycles, and genuine co-investment. Advisors who learn to distinguish between the two will protect their clients and their own reputations. Alan reminds us that uncertainty isn't a reason to avoid alternatives. It's precisely the reason to embrace them thoughtfully. Advisors who built the knowledge, the partnerships, and the discernment to navigate the space will become indispensable to their clients for the long term. Thanks for listening to this episode of The Uncertainty Edge. If today's conversation sparked something, subscribe to the podcast so you don't miss an episode. You'll get practical tools, deeper insights, and new episodes every other Tuesday. Please leave a review wherever you get your podcasts. And you can also subscribe to the newsletter at theuncertaintyedge.com.